An expert is shedding light on just how bad the housing crisis in Central Ohio has become, especially for the elderly.
11 Columbus City Council also approved 8 pieces of legislation and nearly $9 million aimed at combating the city's looming housing crisis.
Ohio's housing market is showing cracks no one can ignore. While headlines still talk about growth, the reality on the ground is very different. Homes are sitting unsold, buyers have vanished, and prices in some towns are far above what local incomes can support. This isn't about hot job centers like Columbus. It's about smaller cities where speculation and pandemic money pushed values way past their limits. Today we're counting down 10 Ohio cities where demand has collapsed and a painful price correction is coming in 2025. Stay tuned until number 1, because that city's correction is setting up what could be the biggest buying opportunity, or the most painful trap, for anyone watching the Ohio market right now. Number 10, Marietta. This southeastern Ohio community sits along the Ohio River, historically supported by oil, gas, and manufacturing industries that provided stable employment for generations. But recent economic shifts have created a dangerous mismatch between housing costs and local earning power. The numbers tell a sobering story. Median home prices climbed 43% since 2020, reaching $197,000 by early 2025. That might sound reasonable compared to coastal markets, but here's the problem. Median household income in this area hovers around $42,000 annually. That creates a price-to-income ratio of 4.7, well above the sustainable 3.5 threshold that housing economists consider healthy. Sales activity has crumbled. Multiple listing data shows new listings down 28% year over year, but that's not because of limited supply. Existing inventory sits stagnant, with homes averaging 91 days on market compared to 54 statewide. Local real estate agents report showings are down nearly 40%, and serious buyer inquiries have dropped even more dramatically. The region's economic foundation is shifting beneath the housing market. Natural gas extraction provided a temporary boom, but that's largely played out. Meanwhile, younger residents continue leaving for Columbus and Cincinnati, creating a demographic cliff that will only accelerate. When oil and gas wealth dries up and population declines, housing demand follows. Industry experts predict values could drop 15 to 20% by late 2025. Number 9, Norwalk. This farming community of 17,000 residents exemplifies how rural Ohio markets became disconnected from local economic fundamentals during the pandemic housing frenzy. Home values here surged 58% since 2020, pushing the median to $212,000. But agricultural income hasn't kept pace. Farm commodity prices have declined significantly from their 2021 peaks, while input costs for seed, fertilizer, and equipment remain elevated. Local farmers who once anchored the housing market are now struggling with cash flow problems that ripple through the entire community. The warning signals are unmistakable. Days on market increased 62% year over year, reaching an average of 78 days. Price reductions have become standard, with 34% of listings cutting their asking prices at least once. That's double the state average and signals desperation among sellers who overestimated buyer demand. Real estate professionals in the area report a fundamental shift in buyer behavior. Agricultural lending has tightened significantly, eliminating many potential farm purchasers who traditionally supported the local housing market. Meanwhile, the manufacturing base that provided supplementary employment has contracted, with 2 major employers reducing their workforces by over 300 positions combined. Casey Shepard, a local realtor with 15 years of experience, recently told investors that she's seeing the weakest buyer activity in her career. Multiple properties that would have sold within weeks in 2022 are now sitting for months with minimal interest. The correction appears inevitable, with local bank economists predicting 18 to 22% declines through 2026. Number 8, Portsmouth. This Ohio River community once thrived on steel production and shipping, but decades of economic transition have created structural weaknesses that the recent housing bubble merely masked. Portsmouth's median home price reached $168,000, representing a 47% increase since 2020. While that seems modest compared to other markets, local income data reveals the underlying problem. Median household earnings average $36,000 annually, creating an unsustainable price-to-income ratio that's pricing out most local buyers. The sales data is particularly concerning. Transaction volume dropped 31% year over year, while inventory climbed 43%. Homes that once sold within 30 days now average 87 days on markets. Local mortgage brokers report that qualified buyer applications have fallen 56% compared to 2023 levels. Population demographics compound the problem. The city has lost 12% of its residents since 2010, with younger families consistently moving to Columbus or Cincinnati for better employment opportunities. The remaining population skews older and has lower disposable income, creating a shrinking buyer pool for increasingly expensive homes. Economic development efforts have struggled to replace the manufacturing jobs that once supported higher home values. Service sector employment dominates, but wages remain well below levels needed to sustain current housing prices. The Appalachian Regional Commission recently classified the county as economically distressed, which historically correlates with housing market corrections of 20 to 30%. Regional housing expert Michael Davidson recently warned that Portsmouth represents a classic case of price appreciation disconnected from economic fundamentals. His analysis suggests values could fall 24 to 28% before reaching equilibrium with local income levels. If you're finding this breakdown useful, make sure to hit that subscribe button and turn on the bell, because we're tracking this Ohio housing correction step by step. Number 7. Lorain. Along the shores of Lake Erie, a community of 65,000 faces a housing market in turmoil after the decline of its steel and manufacturing backbone. The numbers reveal a market in serious trouble. Home prices jumped 51% since 2020, reaching a median of $234,000. But here's the critical issue. Major employers have announced significant layoffs, with Ford reducing its workforce at the nearby plant and other manufacturers following suit. That's eliminating the high-wage jobs that supported premium housing prices. Sales activity has collapsed dramatically. New listings fell 29% year over year, while existing inventory increased 37%. Homes now sit on the market an average of 94 days, which is 51.9% longer than last year, according to recent regional data. That's among the worst deterioration metrics in northeastern Ohio. The demographic trends are equally troubling. Working-age population has declined 8% since 2015. While the median age continues rising as younger residents relocate to Columbus and Cleveland for better career opportunities. The remaining population increasingly consists of retirees on fixed incomes who cannot afford current housing prices. Local realtor Jennifer Martinez reports that serious buyer inquiries have dropped 70% compared to peak levels in 2022. Multiple properties that sellers expected to move quickly are instead becoming stale listings that eventually require substantial price reductions to attract any interest. Industrial analysts predict further manufacturing job losses as companies relocate operations to lower-cost regions. Without the wage base to support current home values, the correction appears inevitable. Housing economists project 18 to 25% declines as the market adjusts to post-industrial economic reality. Number 6. Euclid. With a population of 48,000, this lakefront community struggles to maintain its infrastructure while confronting housing prices that exceed the limits of the local economy. Euclid's housing market tells a story of unsustainable speculation. Values climbed 53% since 2020, pushing the median to $143,999. While that might seem affordable compared to national standards, local income realities paint a different picture. The median household earnings approximately $39,000 annually, creating affordability constraints that are driving away potential buyers. The market correction signals are flashing red. Sales volume decreased 24% year over year, while time on market increased 48% to an average of 73 days. Price reductions have become commonplace, with 41% of active listings cutting their asking prices at least once. That level of seller capitulation typically precedes significant market declines. Infrastructure challenges compound the housing market problems. The city faces millions in deferred maintenance costs for roads, water systems, and public facilities. Rising property taxes to fund these improvements will further reduce housing affordability for current residents and potential buyers. The city's history of housing volatility provides context for current conditions. Euclid experienced devastating crashes in 2011 and 2012, losing over 13.5% of home values during that period. Current market conditions show similar patterns of buyer withdrawal and seller desperation that preceded those earlier corrections. Cleveland State University economist Dr. Sarah Mitchell recently analyzed Euclid's housing fundamentals and concluded that current prices sit 64% above long-term sustainable averages. Her research suggests the market faces pressure for a 20 to 28% correction to restore equilibrium with local economic conditions. Number 5. Maple Heights. This diverse community of 22,000 residents exemplifies how Cleveland area suburbs became vulnerable to severe corrections after years of speculative price increases. The housing data reveals a market under extreme stress. Home values surged 49% since 2020, reaching a median of $128,037. But employment conditions in the area have deteriorated significantly, with several major retailers and service providers reducing their local presence. That's eliminating middle-income jobs that traditionally supported homeownership in suburban communities. Buyer activity has essentially evaporated. Sales transactions dropped 37% year over year, while inventory levels increased 49%. The average time on market stretched to 86 days, nearly double the statewide average. Multiple real estate agents report that showing activity has declined by more than 60% compared to 2023 levels. The demographic challenges are particularly severe. The community has experienced steady population decline since 2010, losing approximately 15% of its residents as families relocate to newer suburban developments or move out of the region entirely. The remaining population increasingly consists of older residents on fixed incomes who cannot afford to move, also cannot support current price levels. Historical patterns suggest this correction could be severe. Maple Heights suffered a catastrophic 16.1% crash in 2011, followed by continued declines that reduced median values by over 30% through 2013. Current market conditions show similar warning signs of buyer disappearance and seller panic that preceded that earlier devastation. Regional banking data indicates mortgage applications in the area have fallen 58% year over year, while foreclosure filings have begun increasing. Local economic development officials acknowledge that without significant employment growth, housing values face downward pressure that could persist for several years. Number 4. Johnstown. Once seen as an affordable refuge from Columbus's soaring housing costs, this community of 5,000 now finds that speculative investment has turned into a serious liability. The price appreciation here defied all economic logic. Home values rocketed 67% since 2020, pushing the median to $258,000. That created a price-to-income ratio exceeding 5.2, well above sustainable levels for a community where median household earnings hover around $49,000 annually. Market activity has collapsed completely. New home sales dropped 42% year over year, while existing inventory doubled. Properties now average 103 days on market, with many sitting vacant for months despite multiple price reductions. Local real estate professionals report that qualified buyer traffic has nearly disappeared. The commuter economy that drove the initial price surge is now working in reverse. Rising gasoline prices and return to office mandates have made Columbus commutes less attractive, while remote work opportunities have decreased significantly. Many speculative buyers who purchased during the pandemic are now trying to exit, flooding the market with properties that few local residents can afford. The correction has already begun in earnest. The market experienced a significant 9.4% decline in 2017, demonstrating sensitivity to economic shifts. Recent data shows price momentum has slowed dramatically, with 2025 showing just 1.39% appreciation compared to double-digit gains in previous years. Rural housing expert Dr. Amanda Foster recently warned that communities like Johnstown face particularly volatile corrections because they lack diversified local economies. Her analysis suggests prices could fall 25 to 35% before stabilizing at levels that reflect actual local income capacity rather than speculative demand from distant buyers. Number 3. Valley View. Northwest of Columbus, a village of fewer than 1,000 has turned from a speculative playground into ground zero for what could become a housing market crash. The appreciation numbers here are absolutely staggering. Home values skyrocketed 119.7% since 2010, completely disconnecting from any reasonable economic fundamentals. The median now sits around $275,000, creating affordability constraints that have eliminated virtually all local buyers. Sales activity tells the story of a market in freefall. Transaction volume collapsed 53% year over year, while properties that once sold within days now sit for months with minimal interest. The village's small size means individual sales can dramatically impact median prices. creating extreme volatility that works in both directions. The economic foundation supporting these prices has completely crumbled. Agricultural income in the area has declined substantially, while commuter jobs to Columbus have become less attractive due to rising transportation costs and changing work patterns. Many residents who could afford homes at previous price levels are now priced out entirely. Historical precedent suggests this correction will be severe. Valley View experienced back-to-back crashes totaling over 20% in 2011 and 2012, demonstrating the extreme volatility inherent in micro-markets. The Village's 9.2% annual price volatility ranks among the highest in Ohio, reflecting the instability created by limited housing inventory and speculative demand. Recent growth momentum has slowed to just 1.72% in 2025, signaling that the speculative fever has broken. With current prices sitting nearly 65% above long-term averages and virtually no local buyer base remaining, housing economists predict corrections exceeding 30% as the market adjusts to post-speculation reality. Number 2. Apple Creek. This Wayne County community of just over 1,000 residents experienced such extreme price volatility that it serves as a warning for what's coming to other overheated markets across the state. The story here reads like a housing market horror novel. Apple Creek witnessed an unprecedented boom that pushed median home values to over $300,000 before the inevitable crash arrived in 2024. That correction wiped out $55,349 in median home values in a single year, representing a 15.6% crash that devastated local homeowners. Despite partial recovery in 2025, the fundamentals remain terrifyingly unstable. The community sits 60% above long-term sustainable averages, indicating that further corrections are virtually certain. Apple Creek's 11.1% annual volatility reflects the inherent instability of small rural markets where limited inventory and seasonal demand create conditions for extreme price swings. The economic foundation supporting any housing market here is essentially non-existent. Local employment consists primarily of agricultural and small-scale manufacturing jobs that pay well below the income levels needed to support current home values. The community lacks the population base, economic diversity, or growth prospects necessary to sustain speculative price levels. Recent buyer behavior confirms that the market is broken. Sales activity remains depressed despite the 2024 correction, indicating that even reduced prices haven't restored buyer confidence. Properties sit vacant for extended periods, and local real estate agents report that serious inquiries are virtually non-existent. The demographic challenges compound the housing market problems. Rural Ohio communities like Apple Creek face persistent population decline as younger residents relocate to urban areas for better employment opportunities. That creates a shrinking buyer pool for an oversupply of homes priced beyond local economic capacity. Regional housing analysts believe Apple Creek's correction isn't finished. The recent boom-bust cycle suggests the market may not have found its bottom yet, with additional declines likely as reality adjusts to post-speculation fundamentals. Number 1. No bets. Once ground zero for speculative excess, this small city of 5,000 south of Columbus is now witnessing that boom unravel in dramatic fashion. The price appreciation here reached absolutely insane levels during the pandemic frenzy. Home values exploded 74% since 2020, pushing the median well above $300,000. That created an affordability crisis that eliminated virtually all local buyers and left the market completely dependent on outside speculators who have now disappeared. The correction signals are beyond obvious at this point. Sales volume has cratered 47% year over year, while inventory has exploded 112%. Properties that once received multiple offers now sit empty for months despite desperate price reductions. Local real estate professionals report that buyer activity has dropped to levels not seen since the financial crisis. Recent growth momentum has collapsed entirely, with 2025 showing just 1.83% appreciation compared to double-digit gains in previous years. This dramatic deceleration indicates that speculative fever has completely broken, leaving behind a market with no fundamental support for current price levels. The community's modest size and limited housing inventory create conditions perfectly suited for volatile price swings in both directions. The same factors that enabled rapid appreciation during the boom now facilitate swift corrections as buyer demand evaporates. OBET's history of significant market corrections suggests another substantial price adjustment is virtually inevitable. Economic fundamentals provide no support for current valuations. Local employment consists primarily of service sector jobs that pay well below the income levels needed to afford homes at current prices. The proximity to Columbus that drove initial speculation has become irrelevant as transportation costs rise and remote work opportunities decline. Housing market analysts predict Obetz faces one of Ohio's most severe corrections, with potential declines exceeding 35% as prices adjust to actual local economic capacity. The combination of extreme overvaluation, buyer exhaustion, and limited economic foundation creates perfect conditions for a devastating crash that will serve as a cautionary tale for speculative markets statewide. The writing is on the wall across Ohio. These 10 cities are only the first wave of a correction set to ripple through markets statewide. When buyers step back and inventory surges, prices follow gravity every time. For buyers, patience will pay off. Most corrections take 12 to 18 months to hit bottom, and opportunities will be substantial for those with cash and financing in place. For sellers, only reality pricing will move homes. Clinging to peak values is a costly fantasy. For investors, distressed markets create generational wealth, but timing is everything. Hit that subscribe button and ring the notification bell because we're tracking every twist in this unfolding correction. Drop a comment below with your own observations about Ohio housing markets. Are you seeing the same warning signs where you live? The correction has begun. The only question now is how far and how fast prices will fall.